Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. His website, MacBethMcLeodGroup.com. Welcome back to the show, Hilliard.
Nice to be back.
Hilliard, the Bank of Montreal is what? Blaming the Bank of Canada for Canada's new booming real estate industry?
So the Bank of Montreal, which is like the fourth or fifth largest bank in Canada, quite a bit smaller than the big three, is saying that the Bank of Canada, by promising to keep the interest rates really low and for having the interest rates go really low, has created this new latest version of the housing bubble, which is quite a violent one in the last few months since the COVID recession hit. And I haven't seen all the details yet, but my initial reaction is the Bank of Canada may have played some role in it, but the Canadian banks are not taking the responsibility for their part in this. Going back to 2013. Around there, the former now retired CEO of TD, which is a much bigger bank than the BMO, he said in an interview that there's no point in one bank turning down mortgage loans to try and slow down the housing. Believe it or not, in 2013 they were already concerned about this housing bubble. He said that there's no point in TD turning down the loan because they'll just go down the road to Royal or BMO or Scotia. So the government has to intervene. The government has to say, limit the amount of new mortgage debt that's created. And that would have limited the increase in the price of housing because the rapid increase in mortgage debt is directly correlated with the increase in housing. So what's happened now is since the COVID hit and everybody got their CERB payments and the CEWS payments and the 6-month mortgage deferral, and I don't think the government anticipated this. Certainly I didn't anticipate it. I don't know if anybody did. People took that money and went out and bought more housing, which is like crazy. So in the fall of last year, October, November, December of 2020, at one point the total mortgage debt outstanding was growing at the rate of 1% a month or 12% annualized per year, which is way above the 7% rate already was way too high, and that existed for a decade or longer. But the recent numbers were much higher. So Bank of Montreal's rate of growth was only 8%. So the question is, are they upset about the property bubble, or are they just upset that they weren't getting their share of the increase in the mortgages that were being created so quickly?
Well, there's no law that says a bank can't up its rate if it thinks it's necessary to cool down the market. But you're right. It's just one bank does it. Plus, Canadians and people around the world, you're not just limited to the chartered banks for getting your mortgage. You can get better deals from trust companies and so on.
Well, you can get different amortizations. Like you can get longer amortizations. There's much more flexibility. But I think the thing is that you need to have the 20% down payment to get away from some of the more stringent rules. So, I think the TD chairman Ed Clark in 2013 was right. The government has to do something, or else one bank will just try and outdo the other bank, and it'll just keep going. And of course, the government did a few things around the edges, but they didn't attack the central problem, which is the rate of increase in mortgage debt. And of course, the government didn't want to take the punch bowl away from the party before the party really got going, and didn't want to, because it's so directly linked to the economy.
Yes, I mean, when you stop people from buying houses, you stop people from working in the housing industry. All the roofers, the drywallers, the electricians, the carpenters, the concrete business, all those things take a hit. Construction, and it has a ripple effect downwards. I mean, take a look at Alberta. Are you guys, with a depressed economy, are you having a housing boom?
Well, there is a bit of it's absolutely shocking because, so one of the main theses is that house prices have outpaced the growth in incomes. And the one exception to that is Alberta, because Alberta, the incomes were much, much higher, because of the oil patch than the rest of Canada. And house prices, although they had gone up a lot, they were still fairly reasonable. They were like 4 to 5 times income compared to close to 10 times in Toronto and 14 times in Vancouver. So you could say that Alberta, but even in spite of that somewhat reasonable market we had, in Alberta, there was quite a slump in housing in Alberta in Edmonton for 14 years, and in Calgary for about 6 years since the 2015 collapse in the oil market. There's been no growth in the housing market, but it never did crash. It just kind of went sideways for all that time. But what's amazing about it is that people still believed, like the true believers, which is the majority of Canadians, in the possibility that house prices could always go up and that housing is always a good investment, even continued to persist in Edmonton and Calgary in spite of the fact that the prices were flat. And we had in Calgary and Edmonton, we had bigger immigration, much bigger than Toronto. Toronto never reached 2%, and Calgary and Edmonton were roughly 2.3 to 2.5% annually for many, many years. So there was no reason for people in Alberta to get excited about the housing market. But they are. So now there's a little mini boom. It's nothing like Toronto and Vancouver, but there's a little mini boom in housing going on right now. And the other thing I noticed is renovation is just incredible. It's like everybody's renovating. They're either selling or they're renovating or they're buying. Those are the only 3 possibilities, and very few people are just sitting. So so for the government, getting back to the Bank of Montreal, Bank of Canada dispute, it's the Bank of Canada having the interest rates go down below 2%. Apparently you can get a mortgage now for 1.5% or 1.75% is part of it, but it's not even the big part of it. It's a small little piece of it compared to the availability of credit and the belief that house prices always go up. Those are the 2 main things. If you've got lots of credit available, and so for the government to stop it, they would have to step in and say, we're going to restrict the credit available. And now house prices would go down immediately, because especially now that they're so much higher, you need more and more credit all the time to keep those prices where they are. I mean, there's no such thing as flatlining or leveling off. You have to increase the amount of credit every year in order to just keep the prices maintained where they are. As soon as you flatten off the credit, or heaven forbid, drop the amount of credit available, house prices have to go down.
What's your point of view if they put a capital gains tax on the sale of your principal residence, considering that you have not been able to deduct the expenses of that home up to this point? A tax out of nowhere means you're surprised, and that was your nest egg you planned to retire on.
Well, it won't be very popular, that's for sure. Now, if they did impose a capital gains tax, there's a couple of things that they would do, I think. I honestly don't think they're going to do it. The budget is coming up in about 2 weeks from now, and they probably won't do it. But if they do it, one of the things they'll do is they'll allow you to deduct your expenses. But did people keep records? I don't know, like going back since you bought the house. The second thing is there will be an exemption, and my recommendation would be for a lifetime exemption up to $850,000, which is the amount that a small business owner can deduct if they meet certain requirements from their income. So they could have a gain on their small business up to $850,000 once in a lifetime, or several repeated small businesses adding up to $850,000 total in a lifetime before they start paying tax on the sale of that business. So it should be the same in the housing market. And that would get rid of everybody pretty much. I mean, there are very few people that have gains that are bigger than that, other than very wealthy people, and they could pay some taxes, or the flippers. And I think it would be great to see the flippers caught in that regard, because there's people that, they'll live in a house for a year, they flip it, they go and get another house and live in a year, flip it, and they've been doing that for their whole lives. And that if you put a nice limit on it, maybe 500,000, maybe 850,000, whatever the number should be, and then people above that can pay taxes. I don't think that would hurt too much, but I don't know how whether that would make it popular. I don't think so. We just go from being very unpopular to being slightly less than very unpopular.
Well, when you talk about, I would have been devastated if I had to pay a big hunk of tax on an asset that had gained so much value here in Vancouver, where Vancouver has never been affordable. I bought in Burnaby. I now live in New Westminster. Vancouver itself has always been a virtually unattainable place to live unless you're a doctor, a lawyer, or some well-paid politician. You can't afford to live in Vancouver.
When I was a kid, we lived in Kerrisdale, and I remember I asked my parents when they sold. So I was 9 when they sold, and we moved to Alberta. And they had bought it $15,000, a 2-story house on Angus Drive in Kerrisdale, which is now like a minimum $1.5 million, $2 million market. And they sold it $18,000. We lived there for about 7 or 8 years. That was a big gain. That was $3,000 gain, and so at that time it was a very middle class part of Vancouver. The expensive part was in Shaughnessy, just a little bit north of there, but in Kerrisdale it was quite reasonable, I thought. But yeah, for many decades. But so that was a long time ago. That was 60 years ago. So in the more recent past, it's never been affordable. And the other thing that they could clamp down on, there's the Canadian mortgage debt issued mostly by banks, but also by many other entities as well. And so the other thing that they could look at would be foreign investing. So when you've got a money launderer coming into Vancouver, and he's paying $2 million or $3 million for a house, and he sells it, even if he sells it at a loss, he doesn't care, because what his main goal is to make that money clean from being dirty. And so even if he buys at $5 million and sells at $4 million, he doesn't care, because now he's got $4 million where he can explain the origin of that money. And so get rid of that, get rid of the excessive debt creation, and the market would become reasonable again.
Well, there is FinTrack, and they can find foreign buyers, but there's no limit on who you can get your mortgage from. So a foreign lender can just foreclose on, a money laundered deal and collect their money that way, and there's no investigation into it.
Mm-hmm.
Yeah, so there's
other ways to do it. You could, like I was thinking about, you could come in as an investor and offer a second mortgage on a property, and then when you could, and this happens all the time, I think, in places like Vancouver and Toronto, the second mortgage is very risky, because if the property is sold and there's more debt on it than value, the second mortgage completely loses everything, whereas the first mortgage gets the bulk of any recovery when the property is sold. But maybe the second mortgage doesn't care, because if he's a money launderer, he just steps in, because the second mortgage is in a position where he can pay out the first mortgage if he doesn't like the loss, taking the loss, and he can take over the property. And that would be a nice way to get some money into a system without having to explain the origin of the money. So there's lots of people in the U.S. and other places that looking at Canada as a very, very easy jurisdiction for money laundering. And Vancouver and Toronto are kind of like the epicenters of the entry of that kind of money into Canada, and it's pushing house prices higher than Canadians can afford. So it would be a great way to attack the problem.
We'll have more with Hilliard MacBeth right after this.
Aven Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aven's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avenresources.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, what's going on with the Keystone XL pipeline cancellation? Is that a permanent deal, and is that another nail in the coffin for Alberta's economy?
So the Keystone, of course, was canceled by Obama, and then it was resurrected by Donald Trump, but they didn't quite get the final approval done. Trump issued the cross-border permit, which is why the president gets involved. But a lot of the jurisdiction over pipelines is at the state level. And there were a couple of permits that they were hoping to get that they hadn't quite gotten yet. And then Biden came in, and on his first day in office, he revoked the Keystone permit. So that was basically it. So the chances for Keystone now are wait until a new administration comes in, which is at least 4 years, and the world may be very different 4 years from now when it comes to the Keystone. So the Keystone pipeline that we're talking about actually is an extension of existing. So there is it's like part 4 of the Keystone, phase 4, I think they call it, and it was going to add 1 million barrels a day, which is essential. That 1 million barrel a day, it was going to be a big boost for the oil sands because the oil sands wants to increase its production. It's exporting close to 4 million barrels a day, and it's got the capacity to go even higher than that. But other events may catch up to it. So when the next window comes up in 4 years, if there's a new administration that would be willing to approve it, the world will have moved on quite a bit. It'll be 2025, 2026, and the requirements of the climate change crisis and the restrictions on burning fossil fuels may overtake the issue of Keystone. Keystone was kind of like a shortcut, if you like, to get the money. The money. I guess that's right. It is the money. The oil to more direct route from Alberta down to the Gulf of Mexico area where the refineries are. The existing Keystone went further east and then eventually hooked into the system and went south from there. So it's kind of like cutting across the corner of the long side of the right angle triangle. And it was going to save $7 to $8 per barrel in the cost of transmitting the oil. So it was pretty big, and oil's at $50 a barrel. That's a big chunk of money. 15% roughly. So it would have been a big gain for Alberta, but chances are slim. And the Energy East pipeline never really made much sense. It was too expensive. There was no room in the existing pipeline that went east on the Trans-Canada main natural gas pipeline. So it would have had to have been a huge expansion capacity, and it just, there's too many other options for people to get their oil on the east coast of North America. And Trans Mountain, unfortunately, has basically been stalled out for a long time. It's stalled out since more than a year ago. Well, I guess mostly because of COVID protocols. But so that basically leaves rail as the option. And rail is expensive, but on the other hand, the railway is useful in that it can be, the rail cars can go anywhere where the best price is. And the shipper doesn't need to make a long-term commitment on rail. They can ship their oil on rail, and then, unlike a pipeline where they have to make a 20-year commitment, the commitment on rail can be much shorter than that. So railways are easier to deal with in that respect. So it looks like rail is the option that's left on the table.
How is Alberta's expansion into plastics going with the deep freeze in Texas? That caused a worldwide shortage of plastics. Is that a market that Alberta could exploit?
Well, so the former government in Alberta, the NDP government, that was in for 4 years, they approved this big petrochemical plant in near northeast of Edmonton, and it's been under construction. And they just announced yesterday an $800 million grant to the, or maybe it's $400 million, some huge amount of money anyway, to help the plant get completed. So it's going to make the pellets from ethylene or from propane that can be used as a feedstock for making any kind of plastic thing. But the pellets will be shipped all over the world. There wouldn't be a plant to make plastic bags or whatever it is should be closer to where the market is. And so this would just be a plant to convert it from the liquid or the gas into a pellet. And but that plant, called the Heartland plant, needed government subsidies right from day one, and now it needs an extra government boost to get it completed. So it's not looking great. The situation is now I have heard people say that the oil and gas is going to come booming back in Alberta, but I'm just having a little trouble envisaging that. There are a few coal-fired plants made for making electricity left in Alberta, and they're being converted, and I think the conversion will be done fairly soon, to natural gas-fired plants. So there's maybe a better future for natural gas than there is for some of the other products. But in every case, there's obstacles, fairly serious obstacles, to any more expansion, and even worse, there might be some decline in the ability to export these products to the world from Alberta.
Did the Alberta War Room, their propaganda office for oil, backfire with its efforts when it decried this children's animated movie where a Sasquatch is worried about oil sands development? And since Alberta put out this notice saying, oh, what a load of crap, millions more people have watched this movie.
Yeah, that everybody watched the Bigfoot movie. That the whole kinds of people that weren't going to watch it. That War Room thing, I don't know what they're trying to accomplish. It doesn't seem to be working. Whatever it is, it's not clear what they're actually trying to accomplish, and whatever it is, they don't seem to be doing anything other than attracting negative publicity for their efforts. The world is moving on. I just finished reading Bill Gates' book, How to Avoid a Climate Disaster, I think it's called. And, it's very well done, very well written. I don't agree with everything he says in the book. There's a few issues that he's a backer of nuclear power, which I think probably is kind of not going to happen, for a variety of reasons. And he's got this really big focus in his book on costs, which really costs have come down so rapidly in some of these renewables that shouldn't be the main focus. The main focus should be the engineering and the viability of these things, and how do we do it? And so the engineering part of it is more important than the cost part of it at this point. But a lot of people are focusing on cost. But all of those things are happening so fast, and there's so many people involved in it. Bill Gates in his book is suggesting that $51 billion will be spent over the next up till 2050. So that's 30 years. So that's, trillion dollars. I said billion. I meant to say trillion. $1 trillion will be spent. $51 trillion. So $1.5 trillion per year for the next 40 years. And that is, the announcement that Biden made recently that he's going to try and get past a $1.9 trillion infrastructure package, which is spread over 10 years. So that's $200 billion a year times 10, $2 trillion. That's over 10 years, only a little bit more than the investment that's been going to go into climate change mitigation every year for the next 30 years. So that is so big and it's happening so fast that I think it's going to leave everything else behind.
The movie, by the way, is called Bigfoot Family, and it's currently on Netflix, if you're wondering what all the fuss is about. But be careful what you draw attention to. It may backfire. We'll have more with Hilliard MacBeth right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, a recent survey found 1 in 3 office workers who's currently working at home says if they have to return to their office full time, they would consider quitting their jobs. What are the implications for commercial real estate with an attitude like that?
Well, I'm amazed, that hasn't had a bigger impact. I think most people are assuming that people will go back to the office towers downtown and commute for an hour each way in Toronto and Vancouver. But, it opens up a whole new world when you could stay home and avoid that. For one thing, you can get way more work done. I've been now working from home for more than a year, and I have no intention of going back, but I'm sure they'll allow me to stay home. But there are some, I recognize that there are some jobs where you just have to go out and you have to go to work. But the workers in the office towers, it's a very suspect thing. And, what's interesting is, in spite of all that, the trend was in place before COVID, actually, where maybe people didn't, the type of work that filled those office towers. For instance, if you look at Toronto, the big banks have 3 or 4 of the big towers there, and they had floor after floor after floor with 50, 75 people per floor, 100 people per floor, whatever. They were working in accounting and things like that. Well, they don't need those now that that's all been automated with computers and stuff. They don't need those people as much. The risk management, for instance, the big banks checking whether the mortgage is safe or not, that sort of thing. I'm sure they had hundreds of people doing that, and now it can be done with models and computers and algorithms. And I'm not saying the risk will be lessened that way, but at least they'll save a bunch of people. So it's the number of people returning to. I remember standing in Union Station watching all the people come off and head over to those towers, just like the masses of people. It rivals, I think, probably Manhattan, and a lot of it is very, very difficult for those people. The commute is difficult. They don't get paid that well, so they have to live way, way out, and an hour or 2 hours away somewhere to be affordable, and that's gotten worse since the last couple of years. So it makes sense now. But what maybe the next step of that type of thinking, and maybe people haven't realized yet, is that if it can be outsourced to where you could live in Barrie or Oshawa or something like that, or out in the outskirts of the Fraser Valley where houses are cheaper. I don't know how far out you have to go to get cheap housing, but probably pretty far. But you could also outsource those places to much, much cheaper places like in India or in Vietnam, because if you're working remotely, it doesn't matter how remote you are, other than maybe if there's a weekly meeting that you'd have to come into, then that would be a problem if you were a continent away. But other than that, if those jobs can be outsourced, they could be outsourced to, not somebody that's making $50 an hour. They could be outsourced to somebody that's making, $5 or $10 an hour. $5 or
$10 a day.
Yeah, exactly. And in some cases, those people might be just as good or better than the people that we're talking about. So that's a scary thought. Once you untether it from the proximity in real estate terms It changes the price for real estate, but it also changes the price for the cost of labor, the cost per worker, and it opens up a whole new set of opportunities and problems.
Hilliard, thank you so much for chatting with us.
Nice to be talking to you.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. Are we going to get a crash again after this developing bubble right now hits its peak?
Well, I think, the fact that this extension of the bubble has been promoted by the mortgage deferrals and the government money and everything, it doesn't change the structure of the thing. It just makes the inevitable crash even more serious and probably more deadly because people are that much deeper into debt before the crash actually happened. If it had happened when it first started to happen, which is back in 2016 or 2017, it was still going to be a bad crash, but it would have been more survivable for many people. And now that it's 4 years later, there's a lot more debt into the system and a lot more pain, therefore, will be felt when it actually does crash.
Friend of the show, Mike Swanson, pointed out a big supply for homes in the U.S. was mortgage foreclosures. And with the moratorium on mortgage foreclosures for months, and again here in Canada, the 6-month deal where you didn't have to pay a mortgage, that meant the supply of homes dropped, and that has contributed to the higher prices. Is that a factor that they forgot about?
Oh, this whole thing is a shock to many, many people, I'm sure. The COVID thing, for example, people didn't want to list their houses because if you're living in your house, who wants to have a bunch of people, realtors and their clients traipsing through the house looking at your house? I mean, nobody wants that. So the people just did not list their houses, even though they probably were interested in selling. And then they didn't have to, as you say, whether they were going to be foreclosed on or whether they were just in serious financial difficulty. The moratorium on mortgage payments and on foreclosures, and that just allowed them to live. In 2008, 2009, the average length of time people lived in their house after they stopped paying the mortgage, stopped paying the taxes, stopped paying everything, insurance, they stopped paying the insurance, was 24 months, 2 full years. They got to live there rent-free, absolutely no cost. What a gift, right? So the banks just didn't get around to foreclosing, and nobody really, they were so busy with other things. And so I don't know what's going to happen this time. There's been, the number of foreclosures has actually gone down, even though, that was the deepest recession since the 1930s. So, it probably means that it's all just been pushed down. They're talking about kicking the can down the road. It just pushed the whole thing out a year or so, and now here we are a year later. So we'll see what happens.
Hilliard, thank you again for being on the show.
Nice to talk to you.
If you have any questions for Hilliard or any of our other guests, you can send them to info@housestreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.